What's going on, everybody? It's Faik here from Finsight Tools, your go-to channel for simplifying finance and accounting using, you guessed it, Excel. Look, we all know that understanding where your business is headed financially can feel like trying to predict the stock market. It's tough, but just like how a good real estate investor analyzes properties before buying, savvy business owners need to forecast their finances to make informed decisions. That's what we're tackling in this video. We're diving deep into 9 powerful Excel forecasting methods that'll give you the clarity you need to make smart financial moves. Whether you're just starting out or you're a seasoned entrepreneur, these techniques are going to be your secret weapon for staying ahead of the curve. Welcome to Finsight Tools, where we simplify finance and accounting with practical Excel techniques. In today's video, we're exploring 9 different ways to forecast your business using Excel. From historical averages to departmental inputs, these methods will help you make smarter financial decisions. Let's kick things off with a method as reliable as a Toyota Camry, the 6-month historical average. Imagine predicting the weather based on one day. You might get lucky, but chances are you'll be way off. It's the same with forecasting. The 6-month historical average gives a wider lens. This method averages your chosen metric, like revenue, over the past 6 months. It smooths out short-term fluctuations or anomalies. Think of it like this. If you're a coffee shop owner, sales might spike during a heat wave, but relying solely on that spike for future revenue would be a disaster. In Excel, select the data range for 6 months and use the average function. Boom! You'll have your average revenue as a starting point for your forecast. Next up, we have a method that's all about consistency, the prior period balance. Imagine you're trying to predict how much money you'll have in your checking account at the end of the month. Now, if you know that you consistently deposit your paycheck and pay your bills on time, you can make a pretty accurate guess, right? That's the essence of the prior period balance method. It assumes that certain line items on your financial statements, like your assets or liabilities, will remain relatively consistent from one period to the next. Let's say your business has a healthy amount of cash on hand and a steady stream of accounts receivable. Using the prior period balance method, you can project those values to be roughly the same in the next period. This method is a lifesaver for businesses that don't anticipate any major changes in their financial position. Now, let's talk about a method that's all about keeping your costs in check. The percentage of revenue method. Here's the deal. Your expenses shouldn't be living in a vacuum. They should be directly tied to your revenue. Think of it like this. If you're selling lemonade, your sugar and lemon costs should fluctuate based on how much lemonade you're selling, right? The percentage of revenue method helps you do just that. It involves calculating key expenses, like your cost of goods sold, COGS, and operating expenses as a percentage of your revenue. Let's break it down with an example. If your historical data shows that your COGS is typically 50% of your revenue, then your future projections should reflect the same percentage. So, if you're forecasting $100,000 in revenue, you know that your COGS should be around $50,000. This method is incredibly effective for projecting variable costs because it ensures that your expenses stay aligned with your sales. It's like having a built-in safety net to prevent your costs from spiraling out of control. Chapter 4, the dollar amount per hire planning for growth. For all you entrepreneurs out there with ambitious growth plans, this one's for you, the dollar amount per hire method. Now, hiring new employees is exciting, but it also comes with a hefty price tag. You've got salaries, benefits, training costs, the list goes on. The dollar amount per hire method helps you factor in these costs when you're forecasting your financials. It's pretty straightforward. You multiply the number of hires you're planning to make by a predetermined cost per hire. Let's say your average hiring cost per employee is $5,000 and you're planning to bring on board 5 new team members. Using this method, you can project a hiring expense of $25,000. This method is particularly useful for departments that are expecting significant headcount growth, like sales or engineering. It ensures that your hiring plans are aligned with your budget and that you're not caught off guard by unexpected expenses. Chapter 5. The fixed assumption. Keeping it steady. Sometimes the simplest approach is the most effective. That's where the fixed assumption method comes in. Think of those bills that never seem to change, like your rent or your software subscriptions. You know exactly how much they'll cost each month because they're fixed. The fixed assumption method takes advantage of this predictability. It involves entering a set amount for specific line items in your forecast based on contractual obligations or historical data. So, if your monthly rent is $2,500, you simply enter that fixed value into your forecast. It's that easy. This method is all about maintaining consistency and eliminating unnecessary guesswork for expenses that don't fluctuate. It's like setting it and forgetting it, freeing up your mental bandwidth to focus on other aspects of your forecast. Chapter 6, the year-over-year YoY growth riding the trend. Let's talk about a method that's all about analyzing historical trends. The year-over-year YoY growth method. Imagine you're a surfer and you're trying to catch the perfect wave. You wouldn't just paddle out blindly, right? You'd study the pattern of the waves, looking for those telltale signs of a big one rolling in. The YoY growth method is kind of like that. It involves projecting future growth based on your historical growth rates. So, if your revenue increased by 15% last year, you can apply the same percentage to next year's forecast. This method is incredibly useful for businesses that have consistent upward or downward trends in their financials. It helps you stay aligned with your historical performance and make informed decisions about the future. Now, let's shift gears to a method that's all about the big picture, the annual inputs method. Imagine you're planning a road trip. You wouldn't just hop in the car and start driving aimlessly, right? You'd map out your route, identifying key destinations and milestones along the way. The annual inputs method is kind of like your financial roadmap. It involves entering forecasted values for the entire year based on your strategic goals, market trends, or any other relevant factors. So if you're aiming for $500,000 in annual revenue, you can break that down into monthly or quarterly inputs. For a more detailed analysis, this method is perfect for businesses that prefer to take a top-down approach to their forecasting. It allows you to set ambitious yet achievable targets and then work backwards to determine the necessary steps to get there. For all you team players out there, this method's for you, the departmental intake method. Imagine you're building a house. You wouldn't expect the electrician to know how to install the plumbing, right? You'd bring in specialists from different trades to collaborate and contribute their expertise. The departmental intake method is kind of like that. It involves gathering input from various departments within your organization to create a comprehensive and accurate forecast. Each department submits its projected revenues and expenses, giving you a holistic view of your company's financial outlook. So, if your marketing team anticipates spending $20,000 on a new campaign, and your sales team expects to generate $50,000 in new business, you can aggregate those values to create a consolidated forecast. This method is incredibly powerful because it fosters collaboration, improves accuracy, and ensures that all departments are on the same page. Last but not least, let's talk about a method that's all about starting with a clean slate, the zero-out projections method. Imagine you're starting a new year. You wouldn't carry over all the clutter and baggage from the previous year, right? You declutter, reorganize, and start fresh. The zero-out projections method is kind of like that for your budget. It involves resetting all your variable line items to zero at the beginning of each period. This method is particularly useful for businesses that want to avoid overspending or carrying over unnecessary expenses. It forces you to justify every single dollar you're budgeting for, ensuring that your spending is aligned with your current goals and priorities. So there you have it. 9 powerful Excel forecasting methods to take your business to the next level. Remember, forecasting is not about predicting the future with 100% certainty. It's about making informed decisions based on the best available information. Just like a good real estate investor analyzes properties before buying, you need to analyze your business's financial trajectory. By using these methods, you'll be well on your way to making smarter financial decisions, minimizing risks, and ultimately achieving your business goals. If you found this video helpful, hit that subscribe button and turn on notifications so you don't miss out on any future videos. To wrap up, these 9 forecasting methods offer a range of options to fit different business needs. Whether you rely on historical averages or gather input from departments, the key is to choose the right method for your financial goals. If you found this guide helpful, make sure to subscribe to Finsight Tools for more Excel and financial insights.